More and more women are becoming the breadwinner of the family, or the caretaker of elderly parents, or are heading up single parent household, either by choice or by circumstance. We cannot deny that with these increased responsibilities comes the need to protect our family. I am Tanya Gale Taylor, founder of Your Personal Wealth Roadmap, and today I will be discussing life insurance. Life insurance is one of those topics that I often describe as a necessary evil, but in reality, it's much more than that. Life insurance can be a fundamental piece of your wealth building plan and can be used as a wealth transfer tool. But let's just say you have no wealth building plan. It is still very necessary that you have some type of insurance to protect your family and your loved ones. I hope you agree with that. So, what is life insurance? Life insurance essentially is an immediate way to provide peace of mind to your family in the unexpected event of a death. Deciding which type of insurance you need can be very tricky. There are many different types of life insurance, but broadly speaking, there is term life and there is permanent life. Term life is generally the cheapest option, and you can purchase anywhere from 5, 10, 20, up to 30 years with very low monthly payment, and that's usually based on your age, your health, and other factors. Once those policies expire, you no longer have insurance and would need to purchase more or become permanently uninsured. Permanent life, on the other hand, is exactly that. You have it for your entire life. It is generally more expensive. There are many different hybrids insurance products as well, which is a mix of term and perm, or a mix of investment and other type of insurance. So you generally purchase your insurance by working with an agent, or it is becoming more common to just go online and purchase policies, sometimes up to $1 million. So how do you know how much insurance you need? And this is where it can get pretty complicated. So I am going to provide 5 things to think about when you are trying to make that decision. First, you want to take an inventory of what you currently have. If you have term, look at when it will expire and whether you are comfortable with the time period. If you have insurance with an employer, I always say never rely on this, because if you stop working with the employer, that coverage will go away, or it will become more expensive since it is generally subsidized or paid for by the employer. Your next step is to determine your total expected needs. And you want to think about, are you married, are you single? If you were to pass away today and you're the breadwinner, you want to think about what expenses would you need to cover. Do you have children? Do you have enough savings or for college, or would you need to factor that in? Do you need to consider childcare if your children are younger, or elder care if the responsibility for taking care of your parents will fall on you? How would you want your family to live after you've passed? Do you need to consider medical expenses or paying off your mortgage or other debt? Do you want to contribute to a charity? Do you want to leave a lump sum in a trust for your children? So these are just some of the things you want to think about as you are making that decision. There is a whole lot more, and of course it's going to vary depending on your unique situation. I would say though that at a minimum, you need to ensure that the coverage plus any additional source of income will cover your current contribution to your family's finances. If you're married, you're going to perform the same exercise for your spouse, even if your spouse is not in the workforce. And this is important because you would need to consider how your life has changed if your spouse should pass away. For example, would you need to take time off from work? The third thing that you want to do is to determine over what period of time you would want the support to continue. Is it until your child is 18 or 24, or when your spouse retire, or some other age? This is totally up to you to decide, and it would factor into how long and how much insurance you would need to buy. Now, step 4 is where you would now decide how much income you expect to have independent of the insurance policy. For example, do you have certain assets that are generating passive income that will continue, like real estate or a business? Or do you have a college savings account for your children? Do you have assets such as stock, portfolio, or a retirement plan? If your children are young, you also want to consider whether or not Social Security survivor benefits would be available for them to receive. Again, while you can consider your employer life insurance coverage, I would not put too much weight on it. So now that you are at the last step, you will need to decide how much insurance you need. And to do that, you're going to add up your total expected needs based on the exercises you did in step 2 and 3. And then you're going to subtract your expected income that we just calculated. And you'll also need to decide what type of insurance you need to purchase. Is it term or a combination of term and permanent? There is really no right answer. And I'm going to say this again. There is no right answer. Ideally, you want to look at your insurance need with your overall wealth building roadmap, as there are so many other variables involved and so many other strategies that you can employ. I know there are a lot of gurus out there and companies that tell you never to buy permanent insurance. I totally and completely disagree with those recommendations. And you must be very careful if anyone tells you that term life policies is the only solution. Everyone has a unique situation, and all the different insurance vehicles serve a different purpose. There is definitely no one size fits all when it comes to buying insurance. Term is definitely the cheapest, and I'll tell you that if you have no insurance or if you have very little money, definitely purchase term insurance as soon as possible, so you have some coverage and you have that peace of mind. You want to shop around. My personal philosophy when shopping for pretty much anything is to get 3 different quotes. Your goal is to find a reputable company with great customer service. There are companies called rating agencies that rate the insurers based on several factors, including their financial strength. That is a good place to start when you're trying to decide what insurer to use. You can also get referrals. The most popular rating agencies are Moody's, Fitch, and AM Best. Then when you buy your policy, you may even consider purchasing a convertible term policy, so that as you do your research, if you find that you need a mix of term and permanent insurance, you may be able to convert some of that policy. It is very important, again, very important that you try to understand your policy. At a minimum, make sure you only purchase a policy that you know you can afford long term, as you do not want to purchase something expensive and a year from now you stop paying and wind up being uninsured again. You also want to understand what happens if you stop paying your policy or if you become sick and cannot pay. Also, be very careful of unscrupulous insurance agents. There are many great agents, but there are many who will try to put you in policies that are not right for you. This is why I'd say to you that it's really important for you to do some of this groundwork and do your research. Empowering yourself with the right knowledge is the most important thing that you can do as you go through this process, because it will allow you to ask all the right questions and it will put you in a position to purchase the right products for you and your family.